So welcome to our fourth lesson on investment appraisal, and welcome to our next method, NPV, as we discussed in the ending of the lesson 3 under this. So we are referring to the same question that we've been using in the lesson so far about the two projects that the organization is undertaking, Project 1 and Project 2. And this time around, we want to use the NPV method to see which project should be accepted and which project should be ignored. So still looking at that project. So we're going to put Project 1 here. And in this case, we're going to go by that schedule and put time down and put cash flow down. And then put our discount factor, which should be at the company's cost of capital, 15%, and we put present value here. So with the Project 1, we are told that now, year 0, the initial investment is 556. And as I told you, year 0 is always having a discount factor of 1. So the same figure comes to the present value segment. Remember, we are using 3 zeros up. Now, in this question, you realize that we are told that every year the company is going to earn $200,000 for the 5 years. So we are receiving the same amount of money over the 5 years. This is where annuity comes in. Are you getting it? So here we're going to be using the annuity from year 1 to year 5. The returns is going to be 200. So we go to the annuity table. Go to the annuity table, the second table, and we read 15 years, the 5th period, and that is going to be 3352. 3.352. And then we multiply. When we multiply, we're going to get 670. Now, we are told that there is a scrap value on the asset of how much? 56,000. So in the 5th year, so this is the, if you want, profit on the project, and this is the scrap value, which is 560 or 56, because we are using 3 zeros at 56,000. But with the present value of the scrap value, we are going to read it from the discounting factor table. Now look at the difference closely. We are receiving the same amount of money for a whooping 5 years. That is why the rate has to be read on the annuity table. But this scrap value is at the 5th year, one time. So we need to read that on the next present value table, okay? Or present value table. So 15 years, 5th year, that will be 0.497. And so when we multiply, that leads us to 28. So when we strike it out, our net present value is going to be positive 142. Now, assuming this was the only project we were appraising, since the net present value is positive, we say that we should what? Accept the project, because that's the decision rule. But since there are two projects, let's look at Project 2 and see what is happening to it. Project 2 is going to be following the same trend, okay? So time, cash flows, discount factor, still at 15%, and then the present value. Then the time is going to be year 0. That one is still 3 zeros up, so let me put that there. That's going to be 1616.00, 1616, negative. From year 1 to year 5, the inflows or the profits, if you want, it's going to be 500,000 every year. Annuity table, the same thing, 3.352. When we multiply, we're going to get 1676. And in the 5th year, scrap value of the asset, or the salvage value. Another name for scrap value is also what? The salvage value. So the salvage value of the 5th year for that asset, we are told, is 5,000. Show that? think I missed something there. Let me go back to my slide and see what I missed. That's 301,000. Scrap value is 301,000. I think I missed that there. So 301. And the present value is 0.497. So when we multiply, we're going to get 150. So net present value of the project 2 is going to be positive 210. Now, so using present values, which of these two projects should a company accept? Now, they are all positive, but you realize that project 2 has what? The highest positive, 210, as compared to project 1, 142. So what do we say? We say that a company should accept project 2. Why? Because project 2 has a higher net present value as compared to project 1. So this is how the NPV can be used in relation to this question. But as you can see in this question is very simple because it doesn't take into consideration anything like inflation. It doesn't take into consideration anything like tax. We are not told anything complex. But let's look at a very serious question in relation to that, with the question we have here in that case. So that's it about this one. You can put it down and we go ahead. Right, so let's look at this complex question, which is going to use our head, which is going to require a lot of calculation and a lot of workings in relation to that. So Rome PLC is considering buying a new machine in order to produce a new product. So the company is considering to buy a new machine in order to produce a new product. The machine will cost $1.8 million. Okay, so sometimes I like to write preambles down so that they sort of help me to be able to do what I have to do, because if it is a complex question like this, then I'm likely to face issues about capital allowance. So I like to put some preambles at the corner here. So the cost of the machine, 1.8 million. And it's expected to last for 5 years. It's expected to last for 5 years, at which time it will have an estimated scrap value of 1 million. Whoa, whoa, whoa. So the economic useful life of the assets and of the project we are appraising, in this case, is 5 years. And then our salvage value, it's $1 million. $1 million. Okay. They expect to produce 100,000 units per annum of the new product, which will be sold for $20 per unit in the first year. So annual sales. So annual units, or if you want annual sales in units, that is going to be 100,000 units. And we are told that they expect it that they will sell it for $20 in the first year. $20 in the first year. What it means is that from the second, third, fourth, and the fifth year, different thing will happen. But let's continue with the question. Production cost per unit at current prices are as follows. Material, $88, and then labor, $7. Now, these prices, or these costs, that is the material cost and then the labor cost, $8 and $7 respectively, are at current prices. It means that is how much they are worth now, okay? But if we are going to be undertaking the project, which is going to be a year from now, this cost is going to be changing, and we're going to be adding inflation to it. But let's listen to what the examiner is saying. Materials are expected to inflate at 8% per annum, and labor is expected to inflate at 5% per annum. That is where the deal is. That is where the deal is. So we've been given the current prices at $8 and $7, and we are told that material will be inflating at 8% and labor will be inflating at 5% per annum. 5% per annum. Next. Fixed overheads of the company currently amounts to $100,000. The management accountant has decided that 20% of these should be absorbed into the new products. Now, I didn't talk to you about overheads, and I didn't tell you about overhead absorption. Now, the fixed overhead of the company currently is $1 million. And the management accountant is saying that we should absorb 20% of this fixed overhead, that is the company is already incurring to the to the new project that is being undertaken. Now, absorption of overheads is not a cash flow. It's not a cash item. Hence, that statement, even though it's in the question, we won't use it in our NPV schedule. Why? Because we can't absorb overheads, and because we are interested in incremental cash flows. These overheads are already being incurred. $100 million, $1 million. It's already been incurred. So whether we undertake the project or we don't undertake the project, this $1 million will still be incurred. So the project is not going to change this. Now, if the project would change the overheads, then the additional overheads that we would have been incurring as a result of the undertaking of the project is what we would have to take into consideration. So since it is something that a company is currently investing in or currently incurring, the $1 million, the 20% absorption, we won't take it into consideration in our investment schedule. This is very important to understand because sometimes the examiner includes stories or statements like this in questions, and students expect, or students think that because it is included in a question, some way, somehow, I have to find somewhere and put it. But absorption of overheads cannot be put into anywhere in the NPV schedule. Let's continue. The company expects to be able to increase the selling price of the product by 7% per annum. The company expects to increase the selling price of the product by 7% per annum. So in the first year, they are going to sell the product for $20 per unit, but from the second, third, fourth, fifth, they are going to be increasing it at a rate of what? 7% per annum. An additional $200,000 of working capital will be required at the start of the project. So when we start the project, there is an additional working capital of $200,000 that a company is going to be requiring. Remember what I told you about working capital. When working capital is an outflow at any point of the project, at the end of the project, that working capital will come in as what? An inflow. So that $200,000 at year 0, we're going to bring it there as an outflow, but at the end of the project, it's going to be coming in as an addition or as an inflow in relation to that. Capital allowances is 25% per annum. Tax rates payable immediately, it's 25%. So listen to what the examiner is saying. He said tax is payable immediately. Immediately simply means that as and when the profit is earned, we pay the tax. So year 1 tax is payable in year 1, year 2 tax is payable in year 2, year 3 tax is payable in year 3, in that order. Assuming the examiner has said the tax is payable 1 year in arrears, then that is where year 1 tax will be taken to year 2, year 2 tax will be taken to year 3, year 3 tax will be taken to year 4, and year 4 tax will be taken to year 5, whilst year 5 taxes will be taken to year 6. So in this case, there is not going to be anything like that. So since the project has a lifespan of 5 years, our schedule is also going to be based on 5 periods. Cost of capital of the company is 10%. So we've been given a cost of capital of the company as 10%, and so that is the discount rate that we are going to be using to be able to discount our cash flow so that we can decide whether this project should be undertaken or it should not be undertaken. So let's look at the requirements. Calculate the net present value of the project and advise whether or not it should be accepted. Calculate the NPV of the project and advise whether or not it should be accepted. Right. Now, so before we solve the question, before we put our schedules down, the first thing we need to consider is to look at the various workings that we need to do. The first workings has to do with the workings about the inflation. The second thing has to do with the workings about the price inflation or the sales inflation. Then we need to look at the workings in relation to the cost of material and cost of labor. Then most importantly also, we have to look at the workings for the capital allowance because it's an area that you don't want to mix in relation to that. So let's look at how we can do that. Right, so let's look at the necessary workings that we need to do. There are 4 workings that we have to do. As I mentioned earlier, workings for the sales to incorporate the inflation, workings for the material cost to incorporate the inflation, workings for the labor cost to incorporate the inflation, and then the key aspect of investment appraisal all the time is the workings for the capital allowance. So these 4 workings are going to be primarily needed for our calculation. So let's begin with it. So we're first going to do workings. So the first workings we want to consider, as I mentioned, is the sales. So the sales value. Or if you want, sales revenue. The manner in which I want to do this is to put my period down, or my time. And that is 1, 2, 3, 4, and 5. Then I'm going to put here the selling price per unit. We are told that in the first year, the company will sell the product at $20 per unit. But after that, let's go back. After that, we are told that the company expects that the selling price will be increasing at a rate of what? Will be increased by 7% per annum. 7% per annum simply means in the year 2, we will have to incorporate the inflation. So in the year 2, the selling price is going to become 21.4. Now, how did we get that 21.4? It's going to be the 20 into bracket 1 plus the inflation rate, which is 0.07. Okay, 0.07 exponent 1. This is what refers to as the Fisher formula. So we're going to be using the Fisher concept to incorporate. Now, in the year 3, it's going to be 22.9. How do we know that? We will use the same approach, 20 out, 1 plus 0.07, this time around exponent 2. In the 4th year, it's going to be 24.5. How do we know? The same approach, 20 out, 1 plus 0.07 exponent 3. Then in the 5th year, it's going to be 26.22. The same approach, 20 out, 1 plus 0.07 exponent 4. So the first year, no inflation is on it. It's $20 per unit. But we are told that from the second year, the selling price will be increased by 7%. So we need to incorporate the inflation on that 20. So on the first year, that inflation will be incorporated exponent 1. On the second year, exponent 1. Then on the 3rd year, exponent 2. On the 4th year, exponent 3. On the 5th year, exponent 4. This is very, very important for you to understand. Now, once we get our selling price per unit, we bring our units to be sold. And this should be in 1,000 units. And that is 100,000. So we're going to multiply that throughout. So multiply that respectively so that now gives us the sales revenue. Okay? So that is going to be 2,000 here. I'm working in 1,000 up. Always work in 1,000 up and approximate your figures to the nearest thousands. Always work 1,000 up and approximate your figures to the nearest thousand. This by that will give us 2140. This by that 2290. This by that 2450. This by that 2622. So this is the sales revenue we're going to take to our NPV schedule. And we need to do the workings for it before we go to the schedule. 2. So let me rub my preambles here. We've already been using them. The next one is the material cost. The issue about the material cost also has inflation in it, so we would have to incorporate the inflation in. So we put a time down. 1, 2, 3, 4, and 5. Then let's bring our material cost per unit. Remember, with relation to the material cost, they didn't tell us that in the first year the material cost will be 20 or whatever. They said that the current material cost is $8 per unit. But we are told that material cost is expected to inflate at 8%. What it means is that right off the bat from year 1, we're going to be incorporating the inflation. So material cost for year 1 is going to be 8.64. How do we know that? Fisher formula. So it's going to be 8 out, 1 plus 0. Inflation rate is 8, 0.08, exponent 1. Year 2, we're going to get 9.33. Fisher formula, 8 out, 1.0.08, 1 plus 0.08, this time around exponent 2. Year 3, we're going to get 10.8, the same thing exponent 3. Year 4, 10.88, the same thing exponent 4. Year 5, 11.75, the same thing exponent 5. Now I want you to look at the treatment of the sales and the treatment of the material cost inflation. It is because of the language that the examiner has spoken in the question, that is why we are working the way we are working. So the first sales value or the sales figure, we are told that in the first year we've been given the sales for the first year. That is why the inflation for the sales didn't start from the first year. But with material cost, that $8 given to us is the current sales, is the current material cost. Sorry, is the current material cost. So if we want to now find out the material cost 1 year from now, which is year 1, then we're going to have to what? Incorporate the inflation and exponent 1. 2 years from now, incorporate the inflation, exponent 2. 3 years from now, exponent 3. 4 years from now, exponent 4. 5 years from now, exponent 5. This is very, very important for you to understand, because as always, the examiner is going to bring an inflation question and you have to know how to incorporate these in your variables. Then units. No P about units, it's in thousands. So by 100, by 100, by 100, by 100, by 100. So our material cost to be taken to the NPV schedule, it's going to be, that's going to be 8640. Am I right about that? About 864, just 864. Then here is going to be 933, 10, 108. Let me make sure I'm not giving you 1008. Okay, 1008. Then here will be 1088, and here will be 1175. So that is also about the material cost. That is also about the material cost. Very, very important. Third is the labor cost. I'm going to squeeze that here. With the labor cost, we're going to have the same thing. So time 1, 2, 3, 4, 5. Now the labor cost will be done the same way that this one is done. Just that labor cost is $7 and it's inflating at what? 5%. So material cost per unit that is going to be, for the first year, inflation will come in, and that will be at 5%. So the first year is going to be 7.53, second year 7.72, third year 8.1, fourth year 8.51, fifth year 8.93. How did we get that? For the first year, it's going to be 7 out, 1 plus 0.05, exponent 1. That is what gave us this figure. Year 2, the same thing, exponent 2. Year 3, the same thing, exponent 3. Year 4, the same thing, exponent 4. And it goes that way. Our units is still in thousands. So 100 here, 100 there, 100 here, 100, and 100. Then we're going to get our labor cost that we will be taking to the schedule. So if we look at that, where we multiply, we're going to get 735, 772, 810, 851, and then 893. So that is the first workings, or the first three workings for the sales revenue, material cost, and labor cost. Please note how the workings were done. Note how the workings were done, because it's very important, especially how we incorporated the inflation into the sales, how we incorporate the inflation into the material cost, and how we incorporated the inflation into the labor cost. Now note that these workings is not part of your ebook, because in the ebook we just included the solutions. So those workings, you would have to do them and put them down in your notes in relation to that. I hope it is straightforward, and I hope you understand how it is done. So you can put it down, and then let's continue. Right. So the fourth and final workings, which also sometimes makes students not to be able to do NPV, is the capital allowance schedule. Very, very important. The capital allowance schedule. So we can call that workings 4. And that's about capital allowance. Now we are told in the question that capital allowance is 25% reducing balance. Now the fact that the word capital allowance 25% reducing balance is used in the question does not mean that is the capital allowance you're going to be calculating. What it actually means is that that is the depreciation rate on reducing balance method. Now, so how is the capital allowance done? I try to put it in this schedule. So I put time here, then I put the cost of the machine, or the net present value of the machine. Then I try to put the depreciation that we're going to be calculating here. Then I'll now put my capital allowance here. Be careful. The depreciation is on reducing balance method at 25%. The capital allowance will be used, will be calculated using the tax rates, because remember, capital allowance is a benefit you are receiving for the usage of the asset, which reduces the total tax that is payable on the revenue generated from the asset. So now in this question, it is just a coincidence that the depreciation rate is the same as the tax rate, but in reality, it's not going to be like that, right? So our depreciation rate is 25%, our tax rate is also at 25%. So remember, the capital allowance will be calculated using the tax rate. So in the first year, the cost of the assets we are told is 1.8. So I'm working in thousands, so I'm ignoring the 3 zeros. So I calculate depreciation, 25% of 1,800, that will give me 450. How do I get the capital allowance? Remember, the capital allowance is what we are going to take into the NPV schedule. So the capital allowance will now be 25% of this depreciation figure, which is going to be 113. As I told you, we don't bring depreciation on the face of our NPV schedule. Why? Because depreciation is a non-cash flow item. But we need to incorporate the issue about capital allowance, because we're going to be paying tax on the revenue generated from the investment, and the capital allowance is a benefit or a relief that we receive for the usage of the assets that we are going to be buying. In year 2, because depreciation is done on reducing balance method, we're going to calculate the net present value. We're going to calculate the net present value or the carrying value. So that's going to be 1,800 minus 450, and that gives us 1350. You got to be careful here. You've got to be careful here. If it was a straight line method, then this same depreciation will be charged, and then the capital allowance will be the same. So in the second year, this is the carrying value now, or the net book value now. We take 25% of that, and that is 338. To get a capital allowance, we now take 25% of the depreciation, and that is 84. Now, he said capital allowance is on reducing balance. So reducing balance simply means as the year goes by, all other things being equal, revenue generated from the assets or the assets benefits or the assets will be wearing out. So you will be receiving less capital allowance as and when the asset ages. Year 3. Year 3 too, we need to get a carrying value, which is the 1350 minus this depreciation, and so that gives us 1012. So we calculate 25% of 1012, and that is 253. Then we now get 25% of 253, and that is 63. You okay? Getting along? Right. So year 4. Year 4, we need to calculate the carrying value. That is 1012 minus 253, and that is going to give us 759. So we do 25% of 759, and that is 190. Then we do 25% of the 190 to get the capital allowance, and that is 47. Now to the year 5. Among other things, this is what I want you to get. At the year 5, we are told that the asset has a scrap value of $1 million. What it means is that at the end of the project, the asset will be sold for $1 million. So you want to be careful when it comes to the final year of the project. So at the year 5, let's get a carrying value of the asset. If we get a carrying value of the asset at the year 5, that is going to be 569. So what it means is that at the year 5, at the start of year 5, the asset could have been sold for 569, but the asset is being sold for $1 million, okay, or $1,000. In this case, what we do in the year 5 is that, what I try to do is that in the year 5, we don't calculate any depreciation. We just deal with the scrap value. So assuming this asset has no scrap value, then in the year 5, we will just take 25% on this 569 in the year 5. But this time around, it has a scrap value, so it is not going to go that way. How is it going to go then? Because it has a scrap value, we're just going to subtract that scrap value of 1,000. So the book value is 569, but we sell it for 1,000. What it means is that the company is making a profit, an extra profit of 431. Now, if you're making an extra profit of 431, what happens here is that you won't receive capital allowance, rather you'll be paying tax, because you are making profit as at the end of the useful life of the assets. So on this 431, we're just going to take a direct 25%, and that becomes the capital allowance for that year, and that will be 107, which is an outflow because we are going to be paying the tax on the assets and not receive any tax, any relief in the 5th year. Now, this workings is very, very important for you to get. So in the 1st year, what do we say? Get a carrying value, subtract the scrap value. Now, if the scrap value is bigger than the net book value, it means that for the difference, you just take the tax rate straight up on it, and that becomes an outflow. It should be in brackets. But assuming it was the other side, so the net book value was more than the scrap value, in that case, you will get a positive here. In that case, we will still do the 25% on this, and then we will still be claiming what? Capital allowance here. Now, this is a workings you don't want to miss. It's a workings you want to understand. So make sure you watch the video over again and make sure that these 4 workings we've done, you understand them. And most importantly, this one, okay, this one. because the capital allowance section is very important. So it is this that we're going to now be taking to our NPV schedule, so that we now calculate the net present value of that. So these four workings are key to set us on the road to be able to do what we need to do, so that we can decide whether the organization should undertake the project or should not undertake the project. So in the next video, we will put all these pieces together, where we now conclude on whether we should accept this project, taking into consideration inflation, taking into consideration capital allowance, taking into consideration working capital, and taking into consideration scrap value on the asset. So four things are the key things that we are taking into consideration, and we want to decide whether the organization can accept the project or should reject the project. So I'll see you in the next lesson as we answer and put together the question.